Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and I'm really excited about today. It's super sunny here in Florida, and I'm excited to maybe get out and hit a little, play a little golf. But I'm only saying that and rubbing it in a little bit to my co-host today, who is Nick Costco, who's up in Chile, Kentucky.
Yes.
Welcome.
Thanks for having me. I just pulled up the old thermometer there, and it said 28 degrees. But tomorrow it's 51 and sunny, so I will hit the links.
You know what we call 28 degrees in South Dakota, don't you? Spring.
It's a spring,
No.
spring, yeah.
We call that May. No, just kidding. It's not that bad. But the greatest people in the world, though, up there. And all right, Nick. So we're going to do a little Q&A today. Just we've gotten some questions recently, and we're just going to kind of tackle those and see if we can help clear up some questions.
Yeah. So, we were brainstorming what we can talk about today. We're going to tackle 3 questions today that we've been asked a lot lately. And one of them, the biggest one that I would tell you, is people have taken note that in the latest, it's not called the CARES Act this time.
It's the Consolidated Appropriations.
Yeah, the CAA. There you go. In there, buried in there, was a change to the life insurance rules.
That's
and
right.
This applies to us. It applies to our clients, current and future. And so right now, the insurance companies are kind of digesting everything that's in there, but we just kind of want to speak to that a little bit. So, Jim, you've been in the business only for about 30 plus years, have seen some changes throughout your time. And so as we start digesting this, why don't you share some thoughts that you have right now about the proposed rule changes and kind of what you see the insurance companies or how you see them handling this?
Yeah, thanks, Nick. Absolutely. So a couple of things is in the 80s, they created the 7702s, Regulation 77, IRC Section 7702, sorry. And 7702 created the amount of money that you could put into a life insurance contract, and they limited it. And they made this line called the modified endowment contract line. Okay. There's some other lines that really are in that legislation as far as how much money you can put in the first 7 years, the most you can put in, all of these things, right? But the one that really, when we're doing infinite banking, the one that comes up the most is the MEC line. Well, what this is going to do is to create 7702, they had a 4% guarantee in life insurance contracts. Now, I'm talking about whole life. I'm not going to talk about UL, okay, because I'm not buying something that's failed twice in the last 40 years, right? But there is a change to UL. Understand that the companies can increase the fees in UL. Okay, enough said. We're not going to talk about UL anymore. But in whole life, there has been a guaranteed rate of 4%. That now they're going to allow companies to lower that to 2%. Okay, now allow companies to lower that to 2%, Nick. That means they can.
Yeah.
Are they going to? Sure, some of them are. Are they going to maybe have other products that have higher guarantees? Well, we'll see. And what I mean by we'll see is all of these companies right now are scrambling to figure out, what does this mean? What does this look like, et cetera. Right. Okay, so let's first talk about the opportunities that we would have, right? One is we could increase the premiums that you're able to put into a certain death benefit policy. Meaning, if I have a $500,000 policy, the policies that are currently available under 7702, I can put more money in the new regulation than I can now for that $500,000 of coverage. Does that make sense?
Yeah. And Jim, I think this is for our audience, and we're going to put this into the show notes, but we're going to put a link to the 10-minute lesson in life insurance video that we have on our YouTube channel, because Jim's talking about some things that I think there's some usefulness to have and some visuals to understand where this MEC line is and why, how this plays out.
Absolutely. And understand that if a company has to pay 4%, they have to reserve a lot more money than if they have to guarantee 2%, right? So what does that mean? Well, it's going to theoretically, it should increase dividend. The non-guaranteed side of the equation is going to get more upside.
Sure.
Okay. I mean, one of the things that I love about whole life and the way that we design whole life is that on the guaranteed side, if I put $1 million in over 10 years or whatever that number is, I'm just using a round number.
Right.
Almost every time I have $1 million or right at $1 million or more on the guaranteed side. Now, Nick, how many things can you put money in and 10 years from now, I can guarantee you
right.
that you're going to have all your money and access to it at 0% income tax.
I did a presentation yesterday for a client, and at 10 years, it was 94% guaranteed
Right.
with the product that we use the most. And there, like you said, there's no investment that you could look at trying to compare it to this, where the projected return 10 years from now would be 94% guaranteed. It doesn't exist. Right.
Right.
And so I think just looking at that from that perspective, and that's no banking, that's not using the money.
Yes.
Right. So it's
right.
such a safe place to store our money, as Nelson said so eloquently in his book, Building Your Warehouse of Wealth. It's such a safe place to store your wealth and have it ready to go so that you can go build more wealth. And as we talk about so often, create passive income that meets or exceeds our ideal standard of living.
Absolutely. Absolutely. So think of it. Another thing is you're going to be able to put more money into the contract. You're going to have less guarantees, but probably more upside on the non-guaranteed.
Yeah.
So when I think of all of that, here's the good news. If you like guarantees, I like guarantees, then buy it now. Get in as much as you can before they change the rules. If you are more on the upside potential, then just know that you're going to have those opportunities in the future to put more money into the policy for a given death benefit, right? And the way that, just for people in the audience that don't know, we don't design policies based on death benefit. We design them based on capitalization. So right. I say I want to put $100,000 or $1 million a year, whatever it is in, and then we make it the smallest death benefit with the highest cash value. In the future, Nick, the bottom line is we're going to be able to make that death benefit lower.
Yeah.
For that contribution, right?
Yep.
And understand that they're going to increase dramatically. It's going to be a big difference, right? Now, the other thing, it's going to, if our cash value is growing more efficiently, potentially, right? Then that's a good thing. And here's the bottom line after I'm in my 33rd year of doing this, is that this still has all of the keys that we need. It's going to have the collateral. We're going to be able to collateralize our cash value and use the insurance company's money. Okay. Thank you. We're going to have access tax-free. They're not attacking, or they didn't change, or even, come close to even discussing changing the tax-free buildup.
Right.
Or the tax-free death benefit.
Yep.
Or any of those things. So just like everything in life, it's 10% of what happens and 90% how you react to it. Yep. And with Create Tailwind, we're going to react to this to analyze all of the policies again with all of the companies, figure out which one works best overall, and those will be the ones that we're using and growing and coaching our clients to use.
Yeah.
And I see this as a potential positive, but there's also part of me that says I'm going to buy as many of these guaranteed policies at 4% as I can get before these insurance companies change.
Well, and here's the thing, the takeaway, two key takeaways. One, the insurance companies are still digesting the implications of this. I believe they have till the end of this year to make the changes. if they want to. Again, some of these companies may make no change. They don't have to. They're just allowed to. So we're kind of in a wait and see a position now. But the other thing that dawned on me as I look at this, because I've read quite a few different uh, an, analysis of this so far, and the key takeaway is that this is all a good thing. I always said what people would ask us, well, what if they change the rules and this isn't so advantageous?
Yeah.
And my response has always been, well, if I were to look at who purchases these policies, you got every Fortune 500 company, most major banks, most community banks. You got a whole bunch of people in Congress. You got both sides of the presidential aisle. Most recently here, if they're going to change this, I believe it's going to change for the better. And they did just change it, and they did change it for the better. And that brings me comfort, just even as a buyer. So myself, but I think that
I'm glad. I'm sorry.
no, go ahead, Jim.
No, I think that what I like what you said, Nick, is here's the thing. It's better for the insurance company, or it's sustainable for the insurance company.
Yes.
Right? They can't sustain 4% in this market. Now, they thought this this low interest rate environment would change. It hasn't. It doesn't look like it's going to for the next few years.
Right.
But I want you to think about something. Are taxes going up or going down?
Math says it's going up.
Right. And it doesn't matter that we're having now it does matter, but it doesn't matter for taxes that we're having a change in quote leadership, okay, at the top of our country. But it's going to happen faster with the leaders that we're going to have here in a day or so. So if I think about it, am I trying to get money protected from taxes? I am.
Yes.
So I can put more money in here. Yes,
Right.
less of it is guaranteed. Absolutely. But I can get more money in. So that's a good thing. Get more money that's tax invisible to the IRS. I mean, that's one of my biggest goals. So I wish they'd just make me invisible to the IRS, but apparently they won't. But so, Nick, I think that's still a key thing. And I would say that the policies that are guaranteeing the 4%, they're available right now.
Yep.
For how long? We don't know.
Yep. So let's what we just kind of touched on there a little bit was I know I said it earlier. Hey, that's no banking. So now we're talking about, hey, there's another question we get asked a lot. I'm going to throw you an easy one here, and then we're going to tackle the real fun one as our third one. But the easy one is one of the products we use right now when we take loans. We get to pick whether or not we have a fixed interest rate or a variable interest rate, and it's pretty unique in the business that we get to make that choice. We can change down the road every loan. We get to pick that. One of the common questions is now, why on earth would I pick a variable loan? Because my consumer brain is averse to that, because I perceive that as risk. Jim, can you just explain to our listeners the difference between a variable and a fixed rate loan, and what we are seeing and by and large advising our clients to do right now?
Absolutely. So that really comes down to a variable loan versus a fixed loan comes down to the direct recognition versus non-direct recognition conversation. So in a direct recognition policy, you have a fixed loan rate, but the loan is recognized in the policy, meaning that they're going to reduce your dividend, right?
Right.
And that reduction comes from the loan rate. Okay. So it's always there. So there's companies that recognize 50 basis points. There are companies that recognize 75 basis points, and so on.
Okay.
So if I want a fixed rate, then I'm going to have direct recognition. Okay. Now, Nelson always said that this doesn't matter because, again, Nelson was trying to say the policy is not the focus, the process is the focus. Your behavior
Right.
is more important than the policy. Okay. Which I wish some of these people on the internet would please listen to that, but they won't.
They're just trying to turn a trick. That's
They're
all.
trying to turn a trick. So in a variable loan, then it's non-direct recognition. Okay. Which means you can take all the loans you want. It doesn't affect your dividend. Okay. So then you think, but what if interest rates go up? Okay. If interest rates go, and let's say that company's paying, I'm just going to use an example, 5%. And let's say that company's paying a 5.2% or 5.3% dividend.
Okay.
Okay. If interest rates went to 7, guess what would happen to dividends?
I would think it would go up.
Absolutely. What do you think is going to happen to loan rates if there's a 2% guarantee instead of a 4?
I think it will probably go down.
Right, but there's always going to be this relationship.
Correct.
Right?
A delta.
And is again, remember, the policy is not the issue. So there's only 2 companies out there that give you a choice. If I couldn't have a choice, then I would choose non-direct recognition. By the way, do I have direct recognition policies? I absolutely do. Am I worried about the recognition? No,
Nope.
because I'm making so much return on my assets and my behavior that my money pool is, again, think of the rates of return that we have. I know this isn't part of the question, but we have the rate of return in the insurance contract. We have the rate of return from the cash flowing assets that we're buying.
Right.
We have the rate of return on the interest that we're saving.
Okay.
We have the rate of return on the lost opportunity cost that we're recovering. And then we have, if we're buying cash flowing assets, we have another rate of return, which is rate of cash flow or rate on cash flow, whatever way you want to say that.
Right.
And then in addition to all of that, we have the legacy rate of return, right? Because someday somebody's going to get a bingo when I graduate from this world, right? And, my kids probably won't be yelling bingo, but I wouldn't blame them if they did when they get the check, right? I stole this, but I always say to my wife, try to look sad at the funeral, right? I mean, if you get the check before the funeral.
I tell people, hey, listen, with Mare, she does not need money if something happens to me. She needs help getting the yard mowed and taking care of the physical structure here, but by golly, do not give her money.
That's right. So variable versus fixed. My first choice is having a choice. My second choice is variable non-direct recognition.
Yep. Hey, and here's the great thing. What we offer here is, hey, we're here to help you sort through that choice. We're not here to tell you what to do. This happened yesterday. Client called, taking his first loan. Why was a variable checked on the form? All right, let's just talk through it, and then you decide. And so that's just part of the coaching we offer, and that's part of the fun that we get to have. And so let's tackle the last one, and it's probably, in my opinion, probably the most important piece, because it really speaks to our behavior. It speaks to banking. It's about the equipment financing video and the part of the book. But so let's tackle this. So Jim, talking to a client the other day, prospective client, he's asking about putting $1 million a year through this. And through the conversation, he says, how much will I have in the first year? And I say, well, you're going to probably have about 62 cents on every dollar. So 620,000. And there's a couple Mississippi's of silence on the other end of the phone, as he's thinking through that cash drag that we call that 38% cost in that first year. And as we talked through it, we got through the first 10 years and whatnot. And he saw the light of why that this is a race, a marathon, not a sprint. We always ask the question, you want to start first or finish first if we're running a race? And of course, everyone wants to finish first. But let's just talk. I'd like to hear you address the audience about, hey, how do we address that 38% and in a multitude of ways that we could talk an hour on this. But the one thing that I want everyone to realize is in our show notes here, we've got a reference to the $10,000 in motion video on our YouTube channel. So check that out. That's the second video in the show notes here today. But why don't you address that, Jim, and we'll wrap up the show with this.
Okay, so I love this question, by the way, because I'm gonna answer the question by asking you a few questions about another business we have.
All right.
Okay, because this is the bottom line of that question.
Yep.
Owner versus customer.
Yep.
Or owner versus non-owner. Okay.
Yeah.
We have a business that we're launching in Louisville right now, right?
That's right.
Okay. The person running that business, they're making money right now.
That's right.
All right. All right. And are we making money?
Nope.
What are we doing?
We're
investing money.
Yeah, we're capitalizing the business.
That's right. And we're in a cash drag situation right now.
Yep.
Okay. Are you okay with that?
I'm excited about it, actually.
Why? Why would you be excited to have cash drag in the beginning?
Because I know what it's going to pay 6, 12, 24 months from now and beyond. It's going to pay me a lot more than the cash drag right now.
Right. Okay. So let's go back to the policy. If you go to page 45 of Nelson Nash's incredible book, Becoming Your Own Banker, and you look at the CD sister versus the IBC sister.
Awesome part of the book.
Sister is the customer and the IBC sister is the owner. And in the first year, they put 5,000. Why 5,000? Nelson wanted this to work for everybody. And he says on page 14, you have to have imagination. Okay. So our $1 million client, okay, he had to have enough imagination to multiply from 5 to 1 million. Okay. But the bottom line is, in Nelson's example, the CD sister is getting 5.5% netting for, she puts in $5,000. She has 5,200 after the first year. Right.
Okay.
The IBC sister puts in 5,000 and has $2,000, a little bit less than $2,000, 1,900 and something.
Yep.
Less than what we're showing today. Right.
Yep. Okay.
But the IBC sister ends up with $706,000 more. Now remember, they're only putting $5,000 in, right? I mean, the IB or the CD sister ends up with $258,000. The IBC sister ends up with $706,000 more than that.
And they only funded this for a few years, right?
They funded it for 7 years.
Yep.
Right. And they financed a $10,000 car over and over again every 4 years.
Now, by the way, example of the possibilities.
The possibilities. If you want an explanation of this, set up a meeting through our website to have a coaching session. We'll walk you through this. You'll see the difference between the owner and the customer. But there is, if you want to be the owner, there's an investment. That first year cash drag is an investment. Typically, I mean, I wish we had just had a bunch of 45-year-old females that would show up, because their policies are so efficient. They're like 105% in the second year, meaning I put that $1 million in and I have 105% of what I put in the second year.
Yeah.
But let's say you're like one of us old guys and it's only 97 or 99%. Basically no cash drag, because I got a ton of death benefit. And if I graduate real early, then my family's going to be yelling bingo again. So, but within a few years, really the second year is really close. And again, depending female, male, underwriting class, somewhere around 100% the second year, which means now as the owner, I'm breaking even and I'm going to start to make money on this. No banking, Nick, yet.
Right. No banking.
No banking yet. But when you look at page 45, when does the IBC sister blow past the CD sister where the CD sister is never going to see the IBC sister again?
It's about a year.
But when they start doing what?
When she starts borrowing from it.
When she starts banking. So what does that tell me? Put in my $1 million. use my $620,000 right away, because I'm going to start seeing those benefits and recovering that cash drag. And I'm going to do it a lot faster than you might think.
Yeah. Yeah. Because you're going to be using the insurance company's money, deploying that. If I deployed 620,000 and in the first year I recouped, say, 800,000 with the insurance company's money, didn't I just earn 180,000 with the insurance company's money? I start chipping away at any cash, quote unquote, drag that I experienced. Why? Because of my behavior. And what we've seen people do is, recoup that cash drag in just a couple years. I mean, my own personal example that I've shared multiple times, I did it in the first few months, and then finance the rest of the policy with the proceeds from the first behavior move. So it's all very doable.
So Nick, think about it. Who's going to pay that cash drag ultimately?
Whatever customers I have out in the world.
Yeah. Our assets.
Yeah.
So don't look at it as a cost to you. If you're putting that money in motion the right way, somebody else is going to pay that cash drag. It's going to take a couple of years, but they're going to pay it, not you. Yeah. And when I think about this, ultimately, what's our goal? Financial independence, right? So the more money we can get in motion, the faster we can get to financial independence.
Yep. Yeah,
and,
absolutely.
And so we have to, it's the behavior. And that's why on this podcast so often we have people that have opportunities to do something with that behavior, or education, or here's how I did it, or, whatever it is. That behavior has to start, and it has to start soon.
Yeah. So here's what I would say, everyone, is that this is what we love to do. We love when people come on as clients or as prospects, and they're like, "Hey, I've got this situation. What's it look like if I run this through my insurance contract?" And we'll walk you through the $1 million example. We'll walk you through whatever that number is that you want to see flow through your system. What are those opportunities that you have with your behavior to tackle? And I promise you, if you're just a prospective client, we're not going to twist your arm at the end of the meeting and say, "Hey, you got to sign here. That's just not how we operate." But that's what we enjoy doing. If that's something you want to do, go to our website, createtailwind.com, click on the Contact Us button. We'll take care of that, setting up an appointment and walking you through this, whatnot. But thanks, Jim, for answering these questions for us. It's I know you added a lot of value to our audience today. You got a couple videos in our show notes. Go watch those if you've not seen those yet. We're constantly trying to add content to the YouTube channel to bring value to you guys. If you've got other FAQs, other questions that you want us to address in a future episode, put those into the form on the Contact Us. We'd be happy to address those in a future episode. But thanks, Jim, for what you did for us today.
Yeah, thank you, Nick. And for the audience, next time you walk into the bank, just decide, would I rather be the owner or the customer? Right? And because I love that last question. I could probably talk about that for another hour, but I won't, Nick. And we're here to help you break away from the herd. Nothing good happens in the herd. Until next time, thank you, Nick, for joining us. And I'm your host, Jim Oliver. Break away.
Want to become your own banker and build wealth on your own terms? We'd love to help. Go to createtailwind.com to learn more and schedule a complimentary consultation.